The indicators show that we are in a stock market decline and might be headed for an even larger correction, recession, depression, whatever you want to call it. But how can we use this to our advantage to not only save our investments, but come out better than before? It's simple. Invest more. And don't hear it from us. Hear it from legendary investor Peter Lynch, who returned on average 29.2% yearly returns.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years. About once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. And you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
We know we're in a market downturn, and it might be tempting to sell off everything to prevent further losses. But here are 3 things we can do during this time. 1, know that in long term, stocks go up. Stocks are investments in business, and businesses focuses on making money. So in given time, though the market might have declined, the stock will eventually go back up if it was a good company that you invested in. 2, buy stocks when they're low, in and during a crash, or as we like to say it, buy the dip. 3, buy good quality stocks in good companies such as Apple, Microsoft, things you know that you'll use 5-10 years down the line. But to top it all off, what is the most important principle to know? You have to do your own research into the companies that you're going to buy stock. You research the cheapest piece of clothing to buy, where to travel, your wife's boyfriend's Instagram, but don't research stocks. Research good companies, buy good stock. Simple as that. No one can predict the stock market in the short term with 100% accuracy, or we'll all be billionaires. But over the long term, stock markets have traditionally gone up. So it's good to buy when it's low, but buy in companies that you know will last a long time. Know history. Invest when prices are cheap, not necessarily when things are good and rosy. Simply put, stocks go up in long term. You buy the dip and buy stocks in good businesses after doing your research. So why not just keep investing in the business you shop at anyways? You believe in Amazon, right? That's why you're shopping there and buying things there every single day. Buy stock every time you shop on Amazon or at any other business that you shop at. With Dow, which automatically lets you see the amount of stock you could get by the price of your product and see the expected returns based on historical data. You know it's a good company because you shop there, and you'll do well when they do well, and you're paying for their goods anyway. Be smart, be proactive. Let's do this.